Hey everyone, you're listening to the Active Turnkey Podcast, a podcast designed for hands-off, passive real estate rental investors. In the Active Turnkey Podcast, you'll hear Tom Olson and Jared Stoltmeister discuss all things turnkey rentals with other turnkey providers, service providers, and rental investors. Our goal is to help you reach your financial freedom and whatever comes after that. Let's go.
Welcome back to the Active Turnkey Podcast. Today, I am your host, Tom Olson, and as you can see if you're watching the video, I am not here with Jared Stoltmeister. Now, he did one of these or a couple of these without me. A couple of the previous ones, I know he had one with John Morion, and we did one with him all together, with me and him, but he was talking about contractors, and that's kind of something that when you start talking about contractors, I might just take over the conversation because I've been in construction since I was 12 years old. And I just kind of felt like it would be better to have just John on there. But now I get to do a podcast without Jared. So as many thumbs up as you guys gave Jared, I am expecting this one to be the best podcast ever because Jared's not on this. What do you think, Josh?
Well, I think the podcast is definitely going to be much better looking.
It looks better already.
Yes.
And as you guys know, if you followed us enough, me and Jared are actually brother-in-laws. And I actually have another brother-in-law with me here in the studio today, Josh Belk. Welcome to the show.
Oh, pleasure to be here again. Thank you.
And Josh has been my CPA since I was 19 years old. I still remember me and him discussing, it was 1996. I actually read the tax code. There was a tax code book in 1996, Josh, and guess how big it was?
I can't imagine.
It was about this big. So if you're watching it, it was a book. Today, I don't think the tax code would fit in a book like this. It might be like...
It's like a library.
It might be a whole library worth of tax code. But it's something that always has interested me. I feel like... I still remember, Josh, you coming to me one day. This was years ago, not anymore. But he came to me. He's like, Tom, you make more money than anybody else I know, and that only pays a 4% effective tax rate, because like we were doing things smart when we started our businesses and trying to set up things to be able to do things properly. And it's one of the things that I always recommend. Like if you're going to get into real estate, even if you're a passive investor, one of those people you have to have on your team is an amazing CPA that not is just an accountant. They just haven't passed their test, but actually understands real estate. So Josh, just give me a little, just maybe give me your frustration about dealing with people that are dealing with accountants that aren't necessarily real estate focused or real estate niched, and just maybe explain the difference between that niche of, there's great accountants and they might be great at like a business, but they don't really understand real estate.
Well, I mean, it's like, sometimes you can go, somebody may call themselves a doctor, but you find out they're a podiatrist, and you need your teeth fixed.
I mean, and even a dentist is a doctor to a certain degree, but I really probably wouldn't let my dentist, operate on my heart.
Right. There's a lot of wonderful accountants out there, and for the most part, accountants are. I don't think I've ever met one that I felt was did a disservice to their clients at all.
Oh, I have.
You may have, yeah.
Josh is just being nice.
I try to be. Otherwise,
he's the nicest guy I know.
Yeah. Otherwise,
just ask him.
Yes. Yeah. Just ask him. The nicest guy I know. But in all sincerity, I mean, I think most professionals try to do the best service they can for their clients. Sure. But and as you spoke to, you want to have kind of in that cabinet of advisors around you. Usually, you want a good accountant, a good attorney that specializes in your area. Mm-hmm. So when you talk about having an accountant that knows real estate, if you're investing into real estate, you can find that helpful because generally they're going to understand probably some of the things we'll talk about in this particular podcast as it relates specifically to real estate investors, to know what opportunities are there, what you can and can't do. Real estate is one of those areas from both an accountancy and a tax standpoint that's a little bit more complex than most of your other, like we talk about a retail, kind of your regular retail business or a service business by far. Just because there's so many different areas that you can invest, so many different directions that you can go, and each one of those nuances in the way that you even structure a deal may provide a different answer as it relates to what is the tax impact of the deal that I'm doing.
Right. I mean, so just if you're thinking about it, when it comes to having an accountant, most people think about taxes, right? But there's really two parts of having a good accountant. One is like making sure the books are right to begin with, and then the other part is that taxes. What is my tax implication? And one of those benefits that you get from owning real estate is depreciation. which is kind of what we're going to talk a little bit about today. But I think that there's other things to be considered of when you're even thinking about depreciation. Before you even get into depreciation, there are some other things that you can do to minimize taxes, to have a tax plan, and it's something that Josh has been focused on more on with his clients lately. And that is tax planning. Actually, planning before the end of the year, because if you plan January or March, it's probably too late, right?
Correct. Yeah, there's only a couple things you can do after the end of the year, as far as to try to minimize your taxes. So most everything that you need to do needs to be done prior to December 31st.
Right. So I just wanted to throw that out there. We're not going to talk a lot about tax planning today, but I did just want to make sure that if I know by the time you're getting this, it's probably in the middle of November. But if you haven't had tax planning yet with your CPA, either you have the wrong CPA or you need to actually go find somebody that you're actually at least asking some questions to, right, Josh? What are some of those questions that you might want to consider asking?
Well, of course, right now we're still kind of waiting for what's going to happen as it relates, and we talk about real estate because there's going to be some impact there as it relates to some of these bills that are in front of Congress, and it is going to have an impact on. And regardless, this whole thing of it's not only going to affect a certain group of people, it's a bunch of malarkey. I mean, it basically is going to impact anyone, and probably for most of your individuals that are going to sit down and listen to this type of podcast are going to be over that $400,000 threshold. So a lot of the tax planning this year has been delayed a little bit. And I know even for myself, trying to put out that year-end tax video that we send, a tax planning video we send out to our clients, and with that scheduling link to do a year-end tax planning call, has been delayed a little bit because we're trying to wait to see exactly what's going to happen. And I think we have a little bit more clarity now as far as what's going to happen. But definitely now that you're into the last couple months, by the time this comes out, you're going to be down to your last 45 to 60 days to make sure that you're getting in front of your accountant and you're working through your numbers. What is the where are you sitting at now, and then what are some decisions you need to make before the end of the year to minimize that tax impact? Absolutely.
So that, I think, is the number one question. Where do you think you're going to be at the end of the year? And I think the smartest of smart ones try to actually start in January. Like if you can kind of start looking in January. So next year, if this is too late for you in this year, maybe you didn't do it this year very well, think about this for next year. Maybe in January and February, start sitting down and being like, what are my long-term goals? What are my short-term goals? Do I have a lot of income right now that I need, some help on? Or am I going to have more income in the future and I need to really focus on more of how do I push this burden on in the future? Which kind of gets on to today's topic. I appreciate Josh bringing this up with the bill, and it is something that's on a lot of people's minds. I just have two quick questions with this, Josh. Like, number one, do you think it's actually going to get passed? And then, because I think we just had this discussion at a meeting I was at, a lot of people are not even sure if anything is going to get passed, and if it does get passed, I think there's always these things where you can start planning for, but you don't really know what to plan for until, like you said, you can actually see. And I'd like to do a podcast maybe on the whole bill once if it actually does come across. So number one, is it going to happen? And then I think number two, just kind of trying to think through some of those key things that might be a problem for some of us.
Well, number one, it will. Of course, we've seen this bill kind of take on different forms, different pieces of it being kind of pulled out of it. Mm-hmm. Will the bill as it is now, will it pass the way that it's sitting now? I don't think it will.
Yeah, I don't think so either.
Will something get passed?
Probably. Yeah.
And so as we kind of see the direction this is going, there does need to be some sort of something that gets passed to kind of save face, I think, especially for the Democratic side of the aisle. And so what essentially that looks like, we kind of have a little bit of an idea. So one thing we do know, if you're a higher income taxpayer, in all probability, your taxes are going to go up. Mm-hmm. So if you're $400,000 single, $450,000 or $500,000, depending on which area we're looking at. If you're married, you are going to see an impact in your taxes. You're going to probably see the QBI deduction eliminated if you're over that level, and then also, they're also talking about this flow-through tax, this additional 3% flow-through tax. So you're probably also going to be impacted by that. So if you're over that $400,000, $500,000 threshold, you're probably going to see your taxes go up. Essentially, it's going to be the elimination of the 20% QBI deduction from your flow-through, and also the additional 3% tax. That is going to be a material impact on. Tom, you and I both fall in that category. Both of us make over that threshold, and both of us have flow-through entities, and so we're both gonna feel that impact. And to say it's not going to affect the middle class, guess who, from like at my firm level, guess whose prices are going up because they have to pay more in taxes. It's going to be the guy making under $400,000 probably because their prices are going to go up.
Yeah, I mean, inflation's a whole nother topic we could probably spend an entire podcast on, but I don't really want to get off on because I do believe that it is going to be uncontrollable for the next, foreseeable future, and I have many reasons to talk about that. Now, just to clarify, when you say this $400,000 threshold, this is your final net number.
That's your adjusted gross income.
Adjusted gross income. So this would be after deductions. This would be after something like depreciation that we're going to talk about today. Correct. So that's why depreciation in this topic, I think, is very important to real estate investors. And honestly, I can still remember one of my investors coming to me telling me that they were making enough money in depreciation to not only not have to pay taxes on the money they were making in real estate, but also like all their income that they were making outside of real estate. So depreciation it's a real significant part of the equation. And I think sometimes people don't even recognize it. And you said before, and I kind of alluded to this, when you're a CPA or when you're doing the books for just a regular business that buys stuff and sells stuff, for instance, all they have to really worry about is two things. They have to worry about their cash flow, which every business has to worry about, right? And then they have to worry about their P&L. There's not really a whole lot of anything else going on. Maybe there's some balance sheet if they're buying items, but the balance sheet isn't as complicated as it is when it comes to real estate. So that bringing in that third component of a balance sheet when it comes to real estate, because it's so cash intensive, can really like either make or break, a real estate investor. Wouldn't you agree?
Yeah, so your typical business, especially if you're talking about retail, they're focused on margins. Real estate investors are looking at ROIs. But where the biggest difference is that there's the advantage with depreciation when you're getting into real estate to where you can essentially cash flow in a very positive way on the front end, even though show a material loss on the front end due to depreciation, where if you're in retail or service, you would not be able to do that.
And this whole podcast actually came up because of some questions and with some of our buyers and buying, turnkey rentals. But before we get into some of those, specific questions that we're going to get into today, why don't you just define depreciation, Josh, and just kind of give us like a little bit of a high overview of what depreciation is, what does it really mean for investors, and how does that actually help investors in the short term and the long term?
Okay, not to get too much into accounting theory, although people
we have to when you get into this
geek out on it a little bit, but the whole concept of depreciation, the point of depreciation, it's kind of in its basic theory form, is to do the best from an accounting end for a proper matching of income and expenses. So if you think about when you go through and you actually spend, so I would go out and I would purchase a cell phone, for example. I'm buying it this year, I write it off this year. Okay, but when you get into an asset that has this cell phone might last me 6 months, or it might last me a couple years. But when we talk about a property, we know that property is going to last over a period of time. So even though you're maybe even buying cash for that property, to kind of align with that concept, that accounting principle of a matching of income and expenses, in order to do that, you're going to write that property off over an extended period of time. And so, and I don't know, I don't know exactly why they determined under tax that a property, a single family residence, for example, would be depreciated over 27 and a half years. Why not 27? Why not 50? Under GAAP, it's 30. And then with a commercial property, it's 39 years. And under GAAP, it's 40 years. So, but that is the timeline that we're currently working under, is 27 and a half years that you write off or depreciate a property, and the concept of that is to kind of a matching of income and expenses.
So a matching of when the property's usefulness became less useful.
Right. So yeah. So essentially, kind of what at some point they determined the useful life of a residential property is 27 and a half years in its form as you buy when you.
So a single family. So let's go back. I think you made some key points that I want to make sure that we do talk about. So the key points you just talked about is single family is 27 and a half years. Mm-hmm. And then you said multifamily?
Well, depending on how many units.
Okay, so what does that constitute?
Yeah, so generally it's generally when you kind of get to the point to where you're at 6 or more units, it depends. Of course, a lot of it depends, but it could be 6 or 8 units. At that point, you start going commercial. Whereas if it's under that, generally you're going with residential.
So a 4-unit building would still go under the 27 and a half years. Mm-hmm. So if you get into this, let's just say I have a 12-unit.
It would be 39 years.
So then you would depreciate this over a longer period of time, 39 years, which means you're going to get less depreciation in the first couple of years.
That is correct.
Which may or may not hurt you, but what I think the whole reasoning behind it, though, and correct me if I'm wrong, Josh, is that you're going to be able to kind of expense this property, what you paid for the property, down because let's just say I paid $200,000 for a house. The whole theory was actually to protect against, in my opinion, them depreciating or like making that entire purchase an expense, right? So let's just say I had $200,000 in cash, and I gave $200,000 and I paid $200,000 in cash. I can't make that entire $200,000 an expense in year one, correct?
Correct.
So it's actually, if you look at it, I think a lot of people are like, oh, it's so unfair that real estate investors get to do this. But really, in a way, it could be kind of unfair from a cash perspective. Does that make sense? So most of the time it's not, and this is why leverage comes into this, and this is why a lot of people teach leverage and they think leverage is so powerful. I think that there's pros and cons to having leverage and not having leverage, 100%. But just understand that, you already talked about the bill that's coming out. And one of those key points in this bill is they're wanting to tax you on unrealized gain, which is kind of it kind of plays into this, if you ask me, because they're basically saying you might have made money in this year, but you didn't actually take the cash, so we should tax you anyways. But it doesn't take into account, well, next year you could have lost money, or what about all the money you could have lost that year?
Well, this is this billionaire tax, and this was they actually tried to do this before. Actually, I think it was during the Reagan administration, and it did not work. So It's not going to take a great case study for them to go back and look. This was tried before and it didn't work, and it's not going to impact. And probably not going to impact anybody in your audience that's listening to this, but just the principle of them trying to reapproach this can be a bit scary, and of course it does create a lot of logistical issues that I think is going to be DOA. Right,
I agree with that, yeah. But I just think the thought of it is I think it's trying to combat this. If you ask me, I'm thinking of I think they're looking at how can we make it so it's not so advantage because I think depreciation in a way can be an advantage if you know how to take advantage of it. Right?
Definitely, yeah. And you're just using the rules, and I know I've mentioned this when we recorded before, Tom, but you have to realize that the tax code is written in a way to get the individual or the business to act in a certain way.
Right, exactly.
And so the point of them instituting some of these rules, we think of the Tax Cut and Jobs Act, which we did an entire podcast on last year or the year before was when President Trump and the Congress at the time passed it, was to really encourage individuals and businesses to invest
in their business,
in their business,
and to keep their business, and to keep their employees,
and even into property, because
right.
It allowed for accelerated depreciation, which we'll get into in certain areas that was not there before. And so it is to get us to act in a certain way. And if this bill passes in some of this form, guess what? It's going to get people to act in a different way. You're going to see cryptocurrency even become more of an issue. You're going to see other people moving and acting in a different way
right.
to combat whatever it is that that essentially the government is trying to get you to do. If it's a negative impact, they're going to find a way to to essentially take those rules and use them in a way that's favorable to them.
Right. I mean, and that's what we always do. But when it comes to depreciation, I'm so defining it as basically
it's a method of matching income and expenses, or in this case here, rent and depreciation.
So I guess that's the kind of the legal or the technical term or the technical definition. But I think it's practically it's really trying to get that property down to its zero value or how much money you've paid for the property. That's really what you're depreciating. You're depreciating what is on your balance sheet. Right. So so let's just start there. How do I know what goes on my balance sheet versus what goes on my P&L?
Okay.
Or on my on the other side of the business.
So let's keep the numbers easy. So I go through and I find a single family rental and I pay $200,000. It's an active turnkey. I bought it from Olson Group. Okay. So I went through and I spent $200,000 on this particular property. Regardless if I paid cash, if I got a loan, whatever the case may be, it does not matter. That $200,000 immediately is going to be broken down into two areas. First, the component is going to be the land. So that land, and generally is 15 to 20% of the purchase price, is going to be apportioned to land. Land is not depreciated. Okay, so land, that $20,000 will stay on your books in perpetuity or until you sell the property. The remaining $180,000, that is the component that's going to be depreciated. So that $180,000, assuming we don't do any of these other strategies we'll talk about, that $180,000, you take that number, divide it by 27.5, and that's the amount of depreciation that you'll take. And so as you begin to depreciate it, then the depreciation expense is going to go to the P&L, and then you're going to have accumulated depreciation, essentially reducing the value of that asset on your balance sheet. When you purchase a property and it needs to be rehabbed, it's not in service yet. So you buy that property for $200,000, but you need to put $40,000 into it. That $20,000 can go to land. You're going to have that $180,000, and then the $40,000 in rehab cost before that property is in service. In service being when you actually have a tenant in it or it is available for rent and you've marketed it. That $40,000 is going to get added to the $180,000. So you have a $220,000 depreciable basis over that 27.5 years, and then the $20,000 still remains. That's going to remain there in perpetuity.
So let's just go back to those numbers a little bit, because I just did some math on my calculator here. So you basically said a $200,000 property. You know, again, these are round numbers. Every property is going to be a little bit different, and some of it's the assessed value, right? You probably pull, or maybe is it just a percentage that you normally pull for land, or is it any of that go off the assessed value?
So generally, depending on where in our case, where the client is investing. You know, a property, for example, in a more of a depressed area is going to have a lesser land value than in an area that you know is a little bit more favorable or higher property values.
Okay, so but let's just use those numbers. $200,000. Let's just say it's $20,000. That's the land value. That's $6,500 a year in depreciation if you divide that $180,000 by 27.5 years.
That's correct.
So that's the amount of money that you're going to be able to take off of your taxable income, say.
Correct.
So let's just say that you made $150,000 this year. And let's just say, like, for all intents and purposes, that your cash flow ended up being, you know, $3,000 from, you know, at the end of the year after you paid property management fees and had paid taxes and paid everything else on the actual asset. Let's just say you end up with $3,000 positive cash flow, which would basically mean your P&L says you made $3,000, right? So your P&L says you made $3,000. Do you pay tax on $3,000 in this scenario?
Well, the $3,000. Okay, so the $3,000. Are you talking about in rent that you collected or after?
No, this was after. So they they collected way more than that, because it's I'm sure this $200,000 property is probably, I don't know, $1,500–$1,600 a month, and let's just say that you multiply that times 12. But at the end of the day, like, they made about, you know, $250 a month, you know. So let's just say they made $3,000 at the end, after all those expenses. They would actually pay, correct me if I'm wrong, they'd pay $3,000 would be their original taxable income, but then the depreciation comes in at negative $6,500. So they're actually now sitting at a loss, a net effective loss on their taxes of $3,500.
Right. Yeah.
Even though the cash flow says that they might have made money.
Correct. Yes.
So just to kind of explain what depreciation is, I think we just had to kind of put some numbers there to kind of really, you know, dig into that. Now, this question came from one of our buyers, actually, and so I wanted to kind of dig into this just a little bit deeper, because you kind of already explained this a little bit in your talkings. But let's just say, you know, this is the Active Turnkey podcast, and the Active Turnkey, we used to do this quite a bit, and we're kind of starting to do this a little bit more. Where let's just say somebody's buying, and I'm buying properties like this myself, even in Florida. The 15 houses I've already bought in Florida this year have all been this way, where I'm buying a house that's already rented. But, like, I know this house needs work. I know that the only way that I can get, like, I think the best way I can get a deal right now in real estate and where we're at in this market cycle is I can buy these houses that nobody else is kind of looking at. And a lot of people don't like to buy rented properties, especially during COVID. I'm just going to give you a hint there. And I think that's part of the reason why, you know, this opportunity is there. But so there's tenants that are in these properties now. And maybe they're under market rent. That's another thing that I've been buying is under market rent properties where everybody's like, oh, that's not a good investment. I'm like, well, I can make it into a good investment once this tenant leaves. So once this lease ends, I can just not renew the lease. I can, you know, make the place vacant. And then I'm like, okay, now I'm going to put this $20,000, $30,000 into this property. What happens then? Because I think we had some confusion already with a couple of our buyers thinking that at that point, like, it all has to get expensed, or I think the word that was used was depreciated, which I don't even think would even be the correct terminology in this situation. I would say expense, because I think there are some ways that you can expense some of this. And for some reason, I think this investor was thinking that this was a bad thing, that he would have to take all this expense in year one and it wouldn't be spread out. I think it really depends on the person's situation. Wouldn't you agree?
Correct. So once a property, so if you end up with a situation where the tenant either has been evicted or in this case here, the lease was run out and they just simply move on, then at that point, the property, if it is not immediately put back available for rent, meaning it's taken out of service and you rehab the property. So you end up with the tenant leaving, and then you have to go in and you have to pour $30,000 into, in gutting a bathroom and putting in new floors,
new kitchens and new
yes,
floors, and
sure.
repaint the whole place and do everything. I mean, typically those expenses would kind of probably be separated out, right?
Correct. So that $30,000 generally would be considered a rehab expense. A lot of times you're going to come in, you're going to hire a contractor. They're going to say, okay, we're going to do this. This is the spec, the list of work that we're going to do, and it's going to be $30,000 in total. You write them a check for the $30,000, and then they go in and do the rehab. So normally that is depreciated, and going back to that timeline of the 27 and a half years. So you're either
so what you're saying is,
the life of the
from
property.
your opinion as a CPA that specializes in real estate, right? Normally, and I agree with him, normally that entire amount would just go on the balance sheet.
Correct.
So the balance sheet means the balance sheet's where you depreciate from. You don't depreciate from your cash flow. You don't depreciate from anything else. Your balance sheet is what somebody out there is saying that you have into the property.
Correct.
I think the banks sometimes think that that's how much your property's worth. I think that's a very bad explanation of what the balance sheet means.
Don't go to bankers for accounting advice.
But when it comes to real life, like that, what it really means is how much money you've actually invested in the property that's supposed to give you a lifetime value of the property. Is that a good way to explain what the balance sheet is?
Yeah, the balance sheet essentially, from a cash perspective, is what you have put into the property.
Right.
It has no bearing on fair market value. It has no bearing on anything outside of just the book value of that asset. It's what you pay for, less depreciation.
Right, but to determine where do you put on your balance sheet versus where do you put it on expenses, like, again, this investor that had brought up this concern, because he was actually thinking this was a bad thing for him, that if he did expense it all in year one, and I'm sure that there are some very aggressive accountants out there that would try to find a way to maybe expense this all in year one. I don't really think that's the best way to go. I know you don't either as well, Josh. But I think even if you want to get really technical, you probably could even have split up this rehab, and you probably could have even said, okay, something like a furnace or a roof or new flooring or gutting a bathroom. Those are all balance sheet items, but maybe something like, I don't know, paint, or maybe something that maybe is a little bit more considered cosmetic may be an expensable type of item, right? I mean, and I think that they would be justifiable in even taking the time to dig in and maybe getting a little extra expense in year one, right?
Right. If you get a detailed list from the contractor, kind of going through and peeling that apart and see what can we directly expense versus what needs to be go on the balance sheet as a rehab. And
to most people, I think that would be considered a good thing. Wouldn't you agree?
Depending on your goals, what you're trying to do.
Right. But again, I think generally speaking, most people, at least I talk to, they have a lot of income somewhere else, and they're trying to figure out where they can get these year one I mean, we've even talked about doing water stations or doing, ATM machines or doing other things that you can get a ton of depreciation, accelerated depreciation year one, or expense the whole thing in year one. And I think to a lot of people, that's a whole tax strategy that you can take advantage of. Now, we're not going to get into all that complication in today's, podcast, but so what you're saying is, let's just say somebody owns a property for a year, and then it goes out of service, and then they do a full rehab. You're saying that for the most part, you would recommend that most or all of that go back on the asset, which means maybe they started with that asset at $200,000, and now the asset is now $230,000. Correct? Mm-hmm. So now the amount that they would depreciate over 27 and a half years would be that $230,000. Actually, not 230 minus the land value. So we'd be at 210. Now, one more thing to just complicate, if that is not complicated enough, and hopefully you're following this, and I think most people are to a certain degree. But if to make it more complicated, I want you to make sure that you understand that after year one, and let's just say you depreciate, we talked about $6,500 in depreciation on that property. After year one, now your balance sheet's going to say $6,500 less. Is that correct?
Correct.
And then year 2, it's going to be less. So it's going to be $6,500 less that, and less that, and less that. Now, I want everybody to understand this is not just a one-time benefit that the government thinks that they're never going to get their hands back in your pockets again. Correct? And I think that's the one thing that I didn't even understand when I first got into real estate when I was 19 years old. I just thought, I read Robert Kiyosaki's book, and he said this was an unfair advantage, and this was something I knew I wanted to take advantage of. But what I didn't really realize back when I was 19 years old, which was, a long time ago, 45 years ago, 25 years ago, not 45 years ago. 25 years ago, I didn't understand that at some point, I'm going to have to pay this tax back, right? So just explain that. When do you pay the tax back?
So when you go through and you sell the property, then at that point you're going to pay the depreciation recapture. So that's essentially a tax on the depreciation you've taken, which is taxed a little bit differently than the capital gains on the sale of the property itself.
So basically, I know we're kind of saying this is an unfair advantage, which it could be, and I know you can 1031 and maybe prolong this time frame, but really, isn't this kind of like a Roth IRA for the government? Well, that's how I kind of almost look at it. Like, government is giving you this benefit, but they are thinking in 30 years, and they know this, in 30 years, that $200,000 property, how much you think it's worth?
But yeah, in 30 years, it's probably going to be double at least.
Yeah, so let's just think about this, everybody. Like, if the $200,000 property is worth $400,000, and you've owned this property for 30 years, how much are you paying tax on, Josh, then, when you sell the property?
Because you've completely depreciated.
Boom.
Yeah.
So now you are paying tax on a balance, on a balance sheet item, on an asset you didn't actually pay for. And you're paying tax on the entire amount. So just make sure that you understand that in some ways, I think some people think this is unfair. And even Robert Kiyosaki calls it the unfair advantage of depreciation in 1031. But in some ways, it is just like what you started the podcast with. It's a way to balance, what was the term that you used? Like, to balance?
It's basically just a matching.
Matching.
Right. Mm-hmm.
To match, one side versus the other side. So at the end, this isn't some great gift that the government's giving us. I think a lot of people think of it like that. You're going to have to pay it back. At some point, you're going to have to pay the piper. This is part of the reason that right after this podcast, me and Josh are going to be talking about my own personal taxes, saying, because there's some properties I know that we depreciated down and we sold for a lot more than what we paid for the properties. And I'm thinking, I need to do some tax planning. What do I need to do, to maybe, minimize this tax? And, I think there's the 1031 kind of comes into play just a little bit here. But I think I'm of the mindset, and I think you are, Josh, too, because we've talked about this, do I even want a 1031 right now? Chances are in 5, 10, 15 years,
the rates are going to be higher.
Those rates may be a whole lot higher than they are today. It might be better to just pay what you can pay now, or do some other tax strategies to minimize your tax today, and then not have to pay that future gain that you're going to have to get tacked on to that next balance sheet item that you'd end up paying in the future, right?
Right.
Anything else, Josh, that you want to just kind of wrap up with depreciation, or anything else that you think that we didn't cover today that you thought might be helpful for our audience? I think it is something that you need to understand, and I think that it's something that you can take advantage of when the time comes. But at the end of the day, I think most people, it seems like at least our audience, doesn't quite understand. I want to make sure that there's a good understanding there.
I don't know if you want me to touch at all on cost segs and real estate professionals.
Sure, yeah, let's get into that just a little bit, because I kind of feel like I think that's where there's some confusion. I think this accountant might think that you just depreciate it all in year one. That's what the one investor said to the other investor, and I'm like, I don't think that's right at all.
Yeah, and I would question whether or not the person was actually an accountant. Whether they really knew what they were doing or practicing. So when you go through and you purchase a property, and a lot of strategy that individuals go through, and even sometimes those who are not savvy in real estate investing, so they may nobody works really a 9 to 5 anymore, but whatever their W-2 job is, they feel that they can leverage that by taking advantage of real estate because of this depreciation. So they feel they can go through and purchase a piece of property and then have what's called a cost segregation study done on this. And we've done this for you and other clients as well. And so what you do is you take that property and you break it down into smaller components. So as you've mentioned many times throughout this podcast, that normally a rental property is depreciated over 27 and a half years. When you go through and you have a cost segregation study done, it breaks that property into multiple components. So you have kind of the furnishings inside the property, which is essentially anything from inside the walls and then you have the land improvements. And so it breaks it down these other components that can be depreciated over a shorter timeline, which now currently under the current tax rules, you can take that full depreciation in year one. So essentially, so say for example that $200,000 property, we have the 180 that we're depreciating. Normally, about 20 to 25% of it in a single family rental, you'd be able to go through and write off immediately in year one. So that 180,000, if we say 20%, doing some quick math here, what's that number? $36,000 in depreciation you can take in year one. Now you can take that full depreciation in year one, and you can actually run that rental property into a loss. So say that $36,000 essentially from a net income end on your financials, will kind of run that down to, say you just have that one property. You collected, say after you rent your expenses, you have $10,000 remaining prior to depreciation. You have a cost segregation done, so now you're at a negative $26,000 net income from your rental. Now, if you
and to most people, they would say that's a good thing because most people that are doing strategies like that have income somewhere else that they're trying to reduce tax exposure to.
So here's the problem: if they are not managing that property. And then many times people, when they go through and they purchase a property, they don't have time to manage that property. So they turn it over to a property manager. So they're not even an active real estate investor. They are just simply an investor with another. At that point, somebody who's in that seat cannot take any of those losses and offset against their income. Now, if they're actively involved in the management of that property, then they can expense up to $25,000 over the so essentially they can recognize up to $25,000 of losses against their active income. And if they are a real estate professional, meaning they meet the hour requirements, and I don't want to do a deep dive into that, but they meet the hour requirements during the course of the year, then at that point their losses can be unlimited. So in that situation, they'd be able to do cost segregation across a bunch of properties. We had a client last year that did, I think, 45 cost segregations on single family rentals. Massive losses. We're gonna do basically an NOL carry forward. So you have to realize when you go through and you purchase a property, if you're wanting to use accelerated depreciation as part of your tax strategy, understanding what you can and cannot do. So make sure you're having that conversation with your accountant. And then identifying which properties it makes sense to do this. If you have a portfolio, to maybe, you have some of them that are cash flowing really well. You bought another property and you want to use that accelerated depreciation, even though you may lose money on that one from a tax perspective, to use those losses to offset against your other rent income. It's a really good strategy to minimize some of your other passive income if indeed you're in a situation where you're not a real estate professional or an active in your real estate.
Awesome. So I think what you're saying is talk to your CPA.
Yeah, so everything that you do, and be really careful because there are
and talk to your real estate CPA.
Yeah, so and you have to be really careful because sometimes we end up with these conversations to where we'll have someone and they have somebody out there trying to sell them a property and using that as a selling point to say, oh, you can buy this property and you can do this, this, and this, and take all this money and offset it against your income as a doctor, as a chiropractor, or whatever it is that you do, only to realize when they have their tax return prepared that their accountant looks at them and says, well, you can't use that depreciation to offset. So just understanding, when you're using real estate is a very, very extremely powerful tool. There's a reason why most of the wealthiest individuals in our country really are focused heavy on investing in real estate. But just to understand how real estate works for you in your situation.
And not only that, like maybe just because you can doesn't always necessarily mean that you should.
Correct.
So like, and I think that's why like you have to have the conversations and you need to understand it, because I think the more you understand, the more it allows you to kind of like tweak things from year to year. Because from one year, I might want to do some of these strategies, and the next year I might not want to do some of those strategies. And just kind of understanding what, like I said, your short term, your long term, medium sized goals, your medium term goals, all those goals, like trying to figure out what they are and how like it's going to affect you. Because if you take accelerated depreciation, it's going to affect you not just this year, it's going to affect you in the future as well.
That's correct. And it's just one part of the entire conversation you're going to have as it relates to using real estate as part of your investment portfolio. So of course there's so much more that goes into it when we talk about your goals. So if your goal is, sometimes a lot of times when people get into real estate, it isn't necessarily for depreciation. They're looking for that kind of that long-term residual that they're going to get, and that conversation sometimes is more important than the depreciation.
And even sometimes this can be, and one thing we didn't talk about that has still not been taken off the table. I know that there was time at one point where they were talking about it. Is talking about that stepped up basis. So it's one thing about depreciation that it's a great legacy when you're talking about passing on wealth to the next generation. Like, I'm not sure, Josh, if there's very many ways that give you that. Then that is a free benefit. That is a benefit that really, if you want to talk about unfair when it comes to families being passed on, like, so let's just say, let's go back to this $200,000 property and you depreciated it down to zero after 30 years, and then you end up dying and passing this on to your heirs. Well, they get a brand new stepped up basis, which means now if the property is worth $400,000 and the land's worth $40,000, they get to depreciate $360,000 over the next 27 and a half years. And it's really like this massive amount of benefit that, like, I think sometimes people are like, well, I want to sell the property because I don't want to, give the hassle to the next people. But like, there are some things where if you made that decision, it may not be the best decision if you think, especially if you think your kids can handle. I know that there's, other worries and concerns about passing on things to kids. But it is something that I know at one point it was on the chopping block and they're wanting to get rid of it. I don't think it's in this current bill that we're in today. But, and maybe some point that might go away. We don't know. But it is like when you talk about depreciation, that is something that part of the conversation that most people should have because, even determining if I want to sell a property or not, like those, you have to kind of think about all the ramifications of all those decisions when you are in real estate.
Right. No conversation should ever be siloed into one area. It's always, where the best conversations are ones that are holistic in nature, to where you're taking overall long-term goals, long-term strategies. Where are you trying to go? What direction are you trying to go? And then instead of just trying to silo your decision based on just 1 year, what's happening right now, but taking a long-term view. And I think that's
most people, I think, have the mindset that, and I would agree with them most of the time, that I want to eliminate as much tax as I can this year. But just understanding that, that does come with future consequences. You may have to pay taxes, and especially at higher rates in the future as well. So, thinking through that, sometimes it might just be better off to pay some tax or think of a different way to be able to, come up with how to maybe minimize taxes in different ways.
Yes.
Any final thoughts, Josh?
I don't think so.
All right.
Probably have.
We did a bang up job. I tell you, this is the best podcast we've ever had here at the Active Turnkey Podcast. I'm sure we're going to get 2 million views on this one instead of 1 million. We've been just hitting that like super high. That mark. I know, Josh, you're surprised, but the crowd is going wild out there. Just so you know.
Yeah. Every time an accountant starts talking, usually these people go to sleep.
And honestly, Josh is an accountant, but I think that from the Active Turnkey Podcast, and I know we have a disclaimer at the front, I don't want this to be construed as necessarily legal or tax advice, but Josh is an accountant, so a lot of the stuff that was coming, was coming from him. But I just want to give you just a little extra disclaimer on this one. But make sure, right, Josh, even you would say this, make sure that you are talking to your accountant and that you are having these conversations. I think that's the biggest takeaway that I'll try to give to this podcast, the audience today, is make sure you're having these conversations. Make sure you understand what you're doing, and at the end of the day, hopefully, you'll be able to take advantage of depreciation in the best way that it suits you. That's going to do it for today's episode. Josh, thank you so much for investing in our audience. If somebody would like to get a hold of you, do you have a website or something that you can join or share with the audience?
Sure. The firm name's Lodestar.tax. It's LODESTAR.tax. Contact information's on there. Shoot us a message on there. I'm on all social media platforms. Not all. I'm on Facebook and LinkedIn. You can reach me on either one of those platforms as well.
And Josh also has a podcast named Belk on Business.
Belk on Business podcast. We just, I think, put out, we're right around 120, 125 episodes out there. So.
And I'll just tell you, most of the podcasts are really good. There's some that are kind of dry. I'm just going to be honest with you. He's an accountant, and he'll probably take that he'll understand where I'm talking about. But sometimes, but most of the time, dude, this is like the best podcast out there, like except for the Active Turnkey Podcast, of course. But honestly, thank you so much, Josh, for having this. I listen to most of the podcasts, and I'm telling you, like I've even texted him and said, "That was a good podcast. Appreciate it. It was good." So thank you again, Josh, for being on that podcast. If you are interested in turnkey rentals, we do build rental portfolios for investors. You guys can contact Jared at buyolsongroup.com, or you can get on our website, get on our buyers list at buyolsongroup.com. That's BUYOLSON. Group.com. And if this was valuable to you, if you learned anything, give us 5 stars on the podcast, give us a share or like, and really what probably matters more to me is to tell your friends about us. Really have those conversations. If you're interested in Josh's tax services from a high level, I know that he's kind of limited who he can take on. He is really only looking for specific real estate investors that are at a high level. But if you're interested in his services, you guys can contact him as well. I'd highly recommend him. I've been using him since I was 19 years old. And he's been a good friend to me as well through the years. So that's going to do it for today's podcast. Active Turnkey, the best way to buy rentals. God bless.
Hi everyone, my name is Ish Deserum. I am a client of Olson Property Services. I am an out-of-state investor, so I really am reliant on a solid group of people on the ground who can manage my portfolio in Northwest Indiana, and I have been able to find that in the OPS team. One thing I think that really differentiates them from others is their personal touch. Shout out to Cheryl and the team. They've done a phenomenal job, and check them out. Thanks.
Olson Group Network makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this podcast. The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Unless specifically stated otherwise, Olson Group Network does not endorse, approve, recommend, or certify any information, product, process, service, or organization presented or mentioned in this podcast, and information from this podcast should not be referenced in any way to imply such approval or endorsement. Any third-party materials or content of any third-party site referenced in this podcast do not necessarily reflect the opinions, standards, or policies of Olson Group Network. Olson Group Network assumes no responsibility or liability for the accuracy or completeness of the content contained in third-party materials or on third-party sites referenced in this podcast, or the compliance with the applicable laws of such materials and/or links referenced herein.